All right. Yeah, Leo, I think we're live. Hey, everyone. Thanks for tuning in. Maybe a quick introduction on the guest that we have on our stream today. It's Leo Chang, co-founder and project lead at Cream Finance. I think most of our audience here is very familiar with Cream, one of the largest decentralized lending platforms on Ethereum, as well as on Binance Smart Chain, of course. I'm Batu Skeen from Binance, and I'll be moderating our conversation today. Leo, do you want to maybe drop some words about yourself, a brief introduction?
Sure. Yeah, thanks for the intro. Thanks for having me. I'm very excited to be here today to talk with everybody about security. It's definitely top of mind for us here and with Cream Finance. So we are a lending protocol much like Compound and Aave, and we have deployed across Ethereum, Binance Smart Chain, and Phantom, and we are the Yearn ecosystem arm of lending. My background's mostly from cloud computing prior to blockchain, and I've had a few years of experience here in the blockchain space. Super excited about DeFi. I think it's very important too, in light of the recent exploits that have happened. And it seems to continue to happen, but I think this is a good opportunity to talk about how users can better think about this, and we can share some thoughts that we have and help everybody get better at this.
Great. Yeah, thank you for the introduction. I should also note that we may get additional guests on our stream today. So don't be surprised, and as they flock in, they'll be happily giving interest as well. But for the time being, I suggest that we move on with our discussion about security in the DeFi space, and kick it off maybe with the first question. Accordingly. So like a rough agenda again for today, the broader topic is about security in the DeFi space. We will be talking about things like smart contract risks, about economic design risks, which are a bit different but still very relevant, flash loans, etc. come to mind, as well as how project teams, and I think with Leo we have someone great expert on the panel, how project teams mitigate those types of risks. As well as how users can mitigate those in light of their own activity. Afterwards, we will take questions from the audience and then conclude the panel. In fact, before we kick off our question rounds, let me add another panels onto the call, which is a rep from Autofarm. Would you like to introduce yourself?
Right. Hello. Sure. Yep. So I'm Giraffe, the founder of Autofarm. So basically, Autofarm is a UX platform as well as a DEX aggregator. So we try to provide DeFi services for basically all DeFi traders. In our pipeline, we also have other services such as portfolio management services, as well as a research toolkit for users. So we try to be an all-in-one DeFi tool suite for just all DeFi traders. Yep. So yeah, that's I guess what Autofarm is about, and we do intend to. I mean, we are operating across multiple chains already. Yeah, and we will continue to expand our services to multi-chains.
Sounds great. Yeah, thanks for the intro. So I think Mindao joined here as well. Our panel is complete. That's great. Mindao, do you want to share some words about yourself as well and your project?
Yeah, sure. Hi, guys. This is Mindao from DForce. Actually, DForce is a very sort of early project, DeFi project in China. We do DeFi protocol matrix, including lending, stablecoins, and things like assets. And we already deploy our lending protocol on BSC and also Ethereum as well. And we are targeting to ramp up our offering to include both stablecoins and synthetic stocks in the coming days. We're talking like next week. So I'm very glad to be here today to share with the audience about some of the security practices that we implemented in the protocol, and also it's great to catch up with you guys as well. Yeah.
Thanks for your introduction as well, Mindao. So let's then go ahead to the first round of questions. Security in DeFi. So let's start high level, and maybe let me address this question first to you, Leo. What are some common things to look out for in a contract that may indicate that specific contract and hence the associated DApp being risky? Leo, I think you're on mute.
Sorry, noticed that my mic was muted. My bad. So I was saying that basically there are things that people can look for, and I think they're actually kind of difficult. And I believe it's probably not the best thing to expect users to look for them. But for those who do want to look, a lot of it's about kind of where the admin keys are stored. Would the project be able to effectively take the money out of the contract, move things around? I think from a very theoretic standpoint, there's kind of like a degrees of decentralization, right? And also philosophical things. So within the Yearn ecosystem, we talk about how it's better to migrate rather than upgrade. So if you have a proxy contract that owns the actual contract as a key, or if that it's a EOA and it's a individual rather than a smart contract that can own the private key. These are kind of the basic risk. Also, moving the money, and then secondly is having these keys to mint more tokens is another thing. So they're basically, I think, generalizing these statements is to understand that the controls of the protocol are as the project team says, and according to the purpose that they need. So it's not always for sure to say, look, just because something is mintable, that's like a really bad thing, or that if something is upgradable doesn't always mean that that's a really bad thing. So, but there are certainly things within the smart contract you can look for, and one of the things that I think is one of the good reference points people should go to is something like DeFi safety, where in it then you can go to DeFi safety and then look for a list of like the projects you've looked at, and then what they'll do is help you look for these things within the smart contract and tell you whether the admin keys are decentralized or not, if it's held by an individual, if there are any kind of best practices within coding, safety, declaration, documentation, etc., that should be captured. But yeah, roughly speaking, I think there are certainly things that users can look for, and it's probably easier to find this information on a consolidated reference point like DeFi safety. And also, I know that Binance Smart Chain is building out more information like this for end users.
Great. Yeah. Mindao, is there anything you'd like to add there as well?
Yeah, I think Leo has actually, talked quite comprehensively on some of the risk sort of protocols that we implemented across some of the lending products, because we're also doing lending like Cream. So I think that some of the I think we are not really concerned about the mint risk or some of the smart contract upgrade risk, because I think at the end of the day, most of the DeFi protocols are actually, if actually they are not fully on-chain upgradable, they probably will be have their own sort of private key control by the team. So I think the bigger risk is probably on the collateral side. That's why I think as a lending protocol, particularly, we can see that Venice has some of the incidents happening several weeks back. I think that's a very severe sort of case, and it's very difficult to prevent. And that's why when we actually onboarding collaterals, we actually carry out very comprehensive risk analysis on some of the collaterals in terms of liquidity, in terms of liquidation and market risk, etc. So I think it is a great. It definitely have a different sort of risk parameters and level. If actually we are looking at different protocols, for example, like AMM and lending protocol are different animals, right? So for lending protocol, I think the attack surface is definitely much wider than a AMM. AMM is a product, is a product that earned its name as the most simple product, right? But lending is pretty comprehensive. I think it's a lot more complicated. So yeah, I would like to share some of our observations, later on in our conversation.
Sounds great. I'll actually in a minute come back to. I'm curious, particularly Leo and Mindao, how your teams assess suitable collateral or certain assets being suitable for being added as collateral on your respective DApps. But before that, maybe I'll wrap from AutoFarm. Be curious to hear your thoughts as well.
Right. Yeah, I think yeah, as what Yang has mentioned, basically as a U aggregator, as currently our primary product is a U aggregator service. It deals with AMMs, which are technically a lot more simple as compared to lending and borrowing platforms. So I guess the major risks that users face will be the pretty general and simple ones, which are are the contracts audited? I mean, audits are not foolproof, but are the contracts verified? Because many contracts are not, and recently we have seen, and many users do not actually check whether they are interacting with a verified contract or not. I think that's pretty important. It's a pretty telltale sign, especially for U aggregators. Generally every single vault generally interacts with a different contract. At least that's how. At least that's how most U aggregators are set up, and so I think users should at least try to see whether the contracts, or at least all the contracts that are being called, are actually verified. Yeah, I think that's pretty important, especially the main one that you are calling, right? So if your MetaMask transaction comes up and it says that you're interacting with this contract, make sure that it's verified, right? I think time locks are also something that a lot of projects. I mean, yeah, users just get caught, right? Without checking whether the contract has a time lock or is it a long enough time lock. Yeah, and I guess upgradable contracts, so it can be pretty it's pretty dangerous if especially if the team is new. There's not much traction with the market yet, and if they want to implement upgradable contracts, I mean there needs to be a good reason, right? To do this. If not, yeah, many projects have gone wrong with the use of upgradable contracts. Yeah, so I think just these simple things should get users on the safe side of contracts in general. Yeah.
Okay, great. All right, so then, yeah, following up on some of the items that also Mindao mentioned there, and that is, I guess, also a bit more relevant to Cream and DeForce, is again, collateral. So how do you guys assess the risk of adding certain types of assets as collateral onto your platforms? What are the variables you're looking at there? And Mindao mentioned a few already, but be curious to hear a bit more deeper insights in order to, again, mitigate all sorts of types of risk accordingly. Leo, maybe if you want to take this one first.
Sure, yeah. So at Cream, we specialize mainly on long tail assets. I mean, of course, we cover the large assets as well, but we push very hard to address the needs of the DeFi user and the lending side, which includes the more exotic assets, longer tail assets, which I think risk then becomes, frankly, higher if not controlled. So those two things we do. One is, as part of our Yearn merger, we've launched the Iron Bank pool, and in that pool, it's only blue chip assets. From that standpoint, we don't require as much of the long tail controls there. And then on the other side too, all the other markets do have the long tail assets. And how we evaluate, generally speaking, is when adding an asset, we want to know if it's useful, first of all, right? I mean, it could be super secure, but if nobody uses it, it's not useful. So there's really two types of assets you think about. One is like productive. So productive, useful assets that both serve as great collateral, as well as great assets to borrow. In that category, it would be like native assets like BNB, like Ethereum or Ether, and BTC, Bitcoin, and all the stable coins, the major stable coins, BUSD, USDC, USDT, etc. And I say these are useful because users both want to supply them, very popular for supply, as well as for borrow. People that's what they go for. And I contrast that with something, say, like our own governance token, Cream. It has value, it has liquidity, but it may not be the thing that most people are borrowing. So that's like two different types of assets. Now, in terms of the assets, we dig into how much on-chain liquidity there might be across. So some projects may have super large exchange volume on Binance.com. But when you think about the ability to basically flash loan, liquidate, or because you don't want to wait for any time it takes to send it from your decentralized wallet to centralized wallets to sell and get it back, is not the same. If you can't flash loan it all in one block, it doesn't quite work the same because price movements can be quick. And also certainly having a very strong decentralized Oracle on it. So whether that's Chainlink or Band or any of the other ones that are up and coming, it's very important to have decentralized Oracle and on top of that coverage. So liquidity depth, we also look at Oracle coverage. We look at the size of the concentration of tokens. And then lastly, we have our own in-house special sauce that we developed that we call it a collateral cap. So I think we need this more so because our markets tend to compose of the more exotic tokens like we talked about. And this one in particular limits the amount of tokens that can be used as collateral. So for example, if we said that there is a XYZ token and we limit that only say $1 million of the XYZ token can be used as collateral. What that means then is some of the attacks we've seen before where more tokens get minted and sold won't be able to impact our program like what happened with Venus, because if the number of tokens are capped in how many can be used as collateral, then that kind of attack can be somewhat mitigated, not entirely, but it definitely does help. So definitely there are a few factors to look at from the token selection, as well as other kind of security features that we implement to ensure that our markets are safe. Because the problem with this pool model, though very efficient, is that one bad asset can wreck the whole pool if it's not mitigated and the risk not isolated.
Yes, that's great insights indeed. Mindao, do you want to chime in there too?
Yeah, I think Liu covered pretty well on because we're actually working on the same model, right? We are using the pool-based lending model, unlike the MakerDAO, which is a CDP, which is silo position. So I think it's a lot easier for MakerDAO to actually customize the risk profile for different CDPs. But I think for a pool-based lending protocol, I think it's very difficult because you're basically in the same basket, right? So if there's any bad thing happening in the basket, it will be actually penetrating through the whole basket. So what we actually stick to, I think the basic principle is we are not going to be onboarding very exotic assets. By that I mean we look at several metrics, right? One is liquidity coverage, how many exchange actually trading that particular token, and second is the liquidity depth. I think Leo talked about. We actually look at what is the, for example, like minus plus 2% or 5% of the liquidity depth across all the exchange. I think this is also a very important matrix. And the other thing is on the oracles. I think a lot of the attacks actually related to oracles. I'm not saying Oracle is not reliable, right? Because a lot of projects are using either Chainlink or Bang, right, or their own protocols. But I think that a lot of projects really don't understand Oracle because Oracle is not really all providing full coverage for all your asset price. And the other thing is Oracle typically don't have a circuit break in terms of the volatility. For example, if you're actually onboarding exotic assets, where, for example, a Chainlink or Bank provide a price fee for that, but if you actually don't have a circuit break, for example, it actually drop like 80% in a minute, right? Typically, we have a circuit break. If actually they drop like 10% within 1 hour, we will stop the price feeds by that time. And if actually using a third-party Oracle, it probably will not stop, right? So actually, it will be a huge risk to your protocol. If actually using a third-party protocol where Oracle where there's no circuit break for the price volatility. So I think that we actually dealing with a lot of these very special exception cases. And I think it really requires a lot of understanding about what lending works and not. Because I'm from a traditional finance background, and I've been in crypto for almost since 2013. So I think I know both of the world better. So I think it's a lot easier for us to understand risk from a traditional finance perspective as well as from a crypto perspective. And I think that we implement several sort of layer of mitigants in terms of the collateral risk. One is the supply cap and the borrow cap. I think we are the very few protocol implement that. Cream, I think, also implement a supply cap. I think initially Compound or Aave, they didn't implement a supply cap. I think it's very risky, right? So even though it's a very safe sort of protocol or token, but I think it's by default we have to implement a supply cap because you don't know what's gonna be happening on the mean rise of a token. For example, there was a token called Phoenix, right? The private key was compromised, and then the hacker managed to actually mint a lot of tokens, right? So for this kind of risk, if actually your lending protocol didn't implement a supply cap, it's not going to be preventing this kind of risk penetrating through your protocol. So I think it's by default we have to implement supply cap. So in addition to that, we also apply we also implement a borrow cap. So for a particular token, the amount it can borrow from the protocol is capped at a certain amount, and it can be released or increased subject to different conditions. And also we have a borrow discount factor, which I think probably we are the only protocol to implement that risk parameters. That parameter is actually take into consideration of the liquidity risk of the asset you borrow out. For example, if actually deposit BTC, WBTC to borrow out stablecoins, we will apply a lower discount rate, meaning you can borrow more money if actually the counterparty token is a stablecoin. But if actually you want to deposit WBTC to borrow like Aave, right, or Compound token, we will apply a deeper discount rate, meaning that you want to borrow a more volatile token, you definitely cannot borrow as much as you can as if you borrow a stablecoin. So I think based on the current sort of lending model, these are some of the basic and probably most of the risk parameters we can implement. I think at the end of the day, the whole sort of operation or safety operation of the protocol is really depending on the team and what kind of risk you really think that is a real threat to the protocol. And even though that we say that DeFi is permissionless and decentralized, but at the end of the day, particularly for the lending protocol, it requires a lot of human inputs. I think this is something that it is definitely necessary at this stage. It's not fully automatic. There definitely needs some human inputs, particularly regarding different aspects of the risk.
Okay, great. Yes. So basically, we've covered a bit, risk associated to technical components, smart contract risk, right? You guys shared some high-level ideas around this. With regards to this specific collateral question, which is very relevant for Cream and DeForce, that's probably more on the economic side of things. As you guys, to give a quick summary here, as you guys have mentioned, you want to make sure, particularly in the design space that you're in, where you pool risk accordingly and don't have individual markets pools only, in order to maybe also facilitate the long tail approach that you're taking. Well, there are certain risks involved, and if you make unfavorable decisions with collateral, there can be issues with liquidations if there's no liquidity on that asset in the first place, etc. I think we can categorize that as economic risk, and that's something that project teams definitely also need to keep in mind, in addition to technical, I guess, questions, as well as potentially users. I mean, they should also question the applications that they're interacting with. from various perspectives, go into the Discord service of the teams and go ahead and ask and participate and contribute then accordingly. It is very, very interesting, though, that is for sure. So having had a little deep dive into some economic risk components, I think one of the more famous one and mostly used one is our flash loans, aren't they? I think we see them being utilized in major cases of sort of exploit events. So yeah, I'd be curious to understand, and maybe our rep from AutoFarm can take this one first. Flash loans, how a project team can sort of think about ways to make sure that they mitigate possible attack vectors that can be enabled by flash loans, which basically is being able to have infinite amount of funds at no cost available to the potential adversarial player, right?
Right. Okay. Sure. This is relatively I guess it's an important question, but it's generally not super applicable to you aggregators, just because of the nature of what you aggregators do for users, just the nature of the service. So right. I mean, sure, there are some strategies which interact with lending and borrowing protocols. So that's in these strategies, then sure, when as in there might be liquidation risks, right? So so for AutoFarm, we currently do not have any strategies that interact with lending and borrowing protocols and have liquidation risks, right? So then the risks of flash loans are severely mitigated, right? So for example, when we were interacting with the Venus lending borrowing protocol, we were lending borrowing in the same asset, right? So then which has exactly the same price. So then any price spikes will not affect basically will not expose AutoFarm users to liquidation risks, right? And another huge I guess strategy that AutoFarm mainly uses is dealing with AMMs, right? So AMMs also generally not very prone to flash loan attacks. Yeah. So I mean, yeah, generally speaking, for you aggregators, I think the only ones that I guess who are affected are with protocols that rely on the price or on a price service to do some action. For example, to mint tokens, and that is where the risks lie, which is generally not applicable to AutoFarm. Yeah, thank you.
Thanks. Yeah, that makes sense. I guess it definitely is way more relevant for instance, lending protocols. So curious to hear the thoughts from the other guests. Leo, you want to take it first?
Yeah, I actually think maybe it's more generalized to think. One thing I do want to say is that flash loans are generally made to be the kind of enemy of a bunch of exploits, and I think, to be clear, to me it's just a tool like anything else, and that if anything it levels the playing field. And I think we probably should also say that as it applies to the lending protocol, what's been helpful for this is that flash loans can lead to self-liquidations or swapping out of assets, as Ave has shown. For the example of lending protocols, it'd be helpful. So say like a user doesn't have a bunch of money sitting around to liquidate people, but liquidation process is very much big for security of lending protocols. And so flash loan enables people to then take a borrow a position in a flash and repay certain assets and be profitable doing that. So I do think that it is a bit flash loans have a bad rap for this, but it has been used as a tool for exploits. But I think much like anything else that can be used for good or bad, it does have a good place for what it's for. But with that said, I will say that generally flash loans accelerate the rate of which some of these things can be done. If you with flash loans, you could do something very quickly to disrupt a price. If you think about something like an AMM with a price that can slip, and so the example of what happened in some of the recent exploits, the flash loan attack is used to game the price feed of an AMM, which then is used to exploit the protocol, which only uses that AMM as a source of a price feed. So a flash loan can very quickly take a piece of important thing like a price feed out of whack and then use that as an attack. So we've seen that happen, and as Mindao had mentioned, that one way to combat this, like what Maker does, would be potentially to throttle the price feed. So delay it by an hour or something like that. And then there are trade-offs involved here too. If you do something where the price oracle doesn't reflect immediately, then what happens in a flash crash? We all know that within an hour, cryptocurrency volatility can change. So I think this becomes a question theoretically. How can you combine a few things together to solve these problems? And I think too that from some of the exploits that have happened, there may be still like outstanding vulnerabilities out there people could use and using the flash loans to attack. But I think it's probably good to also say that generally speaking, flash loans can accelerate certain attacks, but it in itself is not the thing that causes vulnerabilities.
Yes, I think that's very well mentioned. It's not black and white. Yeah, and one can argue that it accelerates also the iterative process in the space, right?
Yes.
So we innovate faster, quicker, and improve faster, quicker because it's very adversarial, and we democratize being adversarial. Everyone has the necessary resources in hands in order to exploit attack, but whilst that may be expensive, while in return there can be positives, we just iterate way faster. And also something that is interesting about flash loans, it's one of the first very crypto native tools that found large usage, right? I mean, the concept of flash loans is super native to crypto. It is not really possible in what we call the traditional financial space. It is the inherent structure and nature and design of the blockchain that enables that. That's very fascinating in itself. Mindao, do you want to add something here as well?
Yeah, I echo Liu's sort of observation, because I think that the lending protocol are definitely the biggest beneficiary of flash loans, right? We are the powerhouse of flash loan, right? Like it's probably a profit center for RV, and we haven't enabled that because we still need to go through a thorough test for enabling it. But I think lending protocol is not a victim for a flash loan. I think the victims, 99% of the cases, are involved with AMMs that misuse or aggregator misuse the AMM price oracle as their major or the only oracle, right? That almost like 99% of the cases happening with a flash loan sort of attack is actually resulting is because of the misuse of AMM oracle. And I think flash loan is a you can look at it as a capital efficient enhancement, and I think it's particularly important because if you look at the liquidation over the past several weeks, is volatile markets. If you actually look back like last year, right, in March 12th, during the liquidation period, we actually have a very heavy liquidation during that period as well. But you know the difference is that at the time, flash loan is not widely used. So when people do liquidation, they have to use their own capital. It's very capital inefficient, and it results in a very inefficient liquidation market as well. But you look at the past 2 weeks, it's absolutely fantastic. We see a lot of people using flash loan to liquidate all the positions in the lending protocol. It's super efficient. You don't need capital. You just borrow from different protocols and then you liquidate. So I think it's definitely a very positive thing that we have flash loan. And as Betu, you say, this is something that never happened in traditional finance, right? This is something that is very crypto native. And I think in general, it's definitely very, very good thing for the DeFi ecosystem, because if you have a more liquid, more efficient liquidation markets, meaning that we can, sustain a much more sort of volatile markets. I think this is definitely something is better. The only thing that need to work out is those guys that actually rely on AMM as Oracle. They need to do their homework, because I think that's the wrong way to use Oracle. It's not. Let us not blame flash loan. It's a very good tool. And I think that probably for anyone that actually have any price or you could rely on AMM, they have to do their homework well. Yeah, that's my sort of view.
Yeah, that's great and very interesting. Actually, one thing you said there, which is that is actually a super critical building block that then also allowed for, let's say, improvements. For instance, from a perspective of liquidations, now you don't. It's more a capital efficient way of liquidations. You don't need to use your own funds. Basically, you democratize that part of the system. Then accordingly as well, everyone can come participate, makes the market more efficient accordingly. Absolutely a very fascinating concept. Indeed. Okay, great. So maybe then moving on from this topic, something I'd also be curious to hear your thoughts and opinions on are the following. So Flash loans very crypto native, something that people associate with DeFi that is also very crypto native. You don't see it anywhere else really. Is the composable nature of the space. So TradFi, the reason maybe why all these neobanks and fintech became quite large is because they managed to break up the siloed data structures of the traditional banks that are very strong guardians, right? But in DeFi, you absolutely don't have siloed data pools at all. It's all composable accordingly. Well, that's great, but I think that also has its own risk factors attached to it. So keyword multiple protocol interactions, right? So your D app does not only talk to users, sometimes it also talks to other D apps, or your smart contracts talk to other smart contracts. And Cream and Alpha Homora, the Iron Bank, that's an interesting case study. Maybe we can keep in mind. But also our rep from AutoFarm mentioned that from a yield farming aggregator perspective, what you see is a layered approach. You have the liquidity sources, the yield sources underneath that, then the yield aggregator, the AutoFarm aggregates. So they really speak to other smart contracts on one side of the thing, and then like middleware. Accordingly, that speaks to the layer of smart contracts on one side of things, and then to users on the other side. Okay, so maybe starting with our rep from AutoFarm, when it comes to isolating risk from multiple protocol interactions, the composable nature of DeFi, are there certain things that you keep in mind before you go ahead and integrate with this application and that application in order to mitigate indirect risk from other parties for your own users?
Right. Okay. Yeah. So for AutoFarm, generally we like to stick with protocols that are non-upgradable, right? So for example, if a yield farm has for example a migrate function, then then we need to be very careful, and we need to cater for what if the project decides to use this migration for whatever reason, and then how will we be affected, and how can we still ensure the safety of users funds, right? So I guess also very like we also take ERC20 tokens or BB20 tokens as like it's a standard, right? But some tokens, even though they seem on outside like they are standard, but actually they're not, right? So they can have varying properties. For example, the rebate property or the fee and transfer property, which I guess we as UI aggregators have to take note when integrating such use sources, right? So I guess it's a combination of testing, simulating operations, checking code to ensure that to cover a downside risk. And ideally we also prefer dealing with protocols that are non-upgradable. Yeah, I think that's something from the U aggregation side, which we can do on a technical standpoint. So with regards to protocols which are upgradable, then we will have to keep up to date on the monitoring of these platforms and set up internal communities to ensure, to keep up to date on the upgrades of these projects or these protocols. Yeah, and also I mean, initially in OrderFarm, we started off with just basically a full native a DeFi experience, whereby we do not have any basically centralized control of the vaults. So basically, when you deposit into the vault, into one of OrderFarm's vaults, it will directly go into into the underlying yield source pools to start earning yield, right? And in the case whereby and also we expect users to be aware of these underlying protocols and what they do, and then take care of their assets on their own, right? But going forward, we also note that some users do not want to do this, right? So they want to pass on the responsibility of or the burden of this I guess work to OrderFarm to help take a more active approach in managing their funds. Yeah, so I guess we are trying to cater for this group of DeFi users as well, and not just for the super native ones. So that's for the yield aggregator side. For our DEX aggregator, AutoSwap, we also I mean we have noticed that other DEX aggregators okay, so yeah, so I think we're one of the few DEX aggregators, or the only DEX aggregator that does whitelisting on our routers. So basically we only whitelist DEXs or DEX routers which we can go through. So this reduces the attack surface area of potential exploits, or even security against the governance of the project significantly, right? Yeah, I think as a standard, whitelisting is always better than blacklisting, right? Yeah, so I think yeah, this some of the things that we do to mitigate risk related with dealing with multiple protocols.
Great. Yeah, thanks. Minao, do you want to add something here?
Yeah, I think for the composability risk, I think it's actually aggregate from the bottom up, right? So I think that for the more sort of protocols that are on the upper layers, it definitely impacted most. For example, AutoFarm, which aggregate all the protocols from bottom up, right? For lending protocol, it's actually on I think it's a more like fundamental layer protocol. The only sort of risk, composability risk we exposed to is from the asset protocol. For example, we have USDC, USDT, and DAI, and you know that most of the protocol didn't actually enable USDT as collateral. It's exactly because we don't know what's going to happen there, right? And I think there's also like DAI is also a very, very big risk. I think it's a very big risk for the whole DeFi ecosystem. So there's anything happening on a MakerDAO protocol, it will penetrating through the whole DeFi ecosystem from the bottom up. And that's why, as I actually iterated my point before, I think for lending protocol, you have to implement a supply cap, because if there's anything bad happen on MakerDAO level, for example, the infinite minting of DAI, right? It flood the whole ecosystem. If actually you have a supply cap, it still can mitigate the risk to a certain extent. So I think when we're talking about composability risk, is really we have to look at which level your protocol is sitting. For a lending protocol, I think we definitely is less exposed to composability risk from the upper layers. But I think that the two most critical one is the asset. We have to look at asset very carefully. That's why we actually not really onboarding a lot of exotic assets. And the other one is Oracle. I think these are two sort of most critical composability risk for a lending protocol. Yeah.
Great. Yeah, thank you. Leo, maybe you as well. And as mentioned before, there was the previous event with the Iron Bank and Alpha Homura. Maybe also interesting, as it ties into this question, some of the learnings that you actually drew from there as a team.
Yeah, I think Mindao touched on a lot of the things that as a lending protocol should do. I think to kind of follow up on that, one place where I think our opinions diverge here is that we think that USDT is a key part of the DeFi ecosystem in itself, is not any less credible than say USDC or BUSD or any other ones. So we do think that, I guess that's where I think our philosophy is slightly different, and also on the standpoint of long tail of assets. So we did build the supply cap, and then we built the collateral cap that then allows for any amount of deposits, but certainly the amount used for collateral is limited. As it relates to protocol to protocol composability, one thing that so the Iron Bank does, for those who may not know here, the Iron Bank does have a protocol to protocol lending, which allows for it's like an advanced form of composability is how I look at it. Because the kind of aha moment for me was when I really dissected a flash loan anatomy, and I think about how in a flash loan, you have, some amount of liquidity source where you borrow from, and then you go to an AMM, you switch it for the underlying thing that maybe you take to a lending protocol, and then you liquidate a position, and you bring it back to AMM, and then you go from that AMM, swap back to the original asset you borrowed, and then you go back to the liquidity source where you did the flash loan. Like, in that sense, unlike Web 2, there is no okay, I got to get my credentials to log in between bank A to bank B to bank C. Is no, the EVM just takes care of everything, and everything just runs in between, and that's composable, and that's great. But then the thinking became, well, to really achieve capital efficiency, why then do you have to say, well, a collateral is on, for example, DForce, but hey, maybe I want to borrow something for Cream? Like, from a user standpoint, I have some collateral locked up in some smart contract in this world. Is it possible that we can then say, I got collateral here, and as long as the place I'm borrowing at is able to liquidate in between, then the individual or the user doesn't have to have a collateral from the borrowing side? At least that's how you can think of, in some ways it's uncollateralized directly on a platform, but in other ways it is collateralized on another platform. So to take this into a practical example, the partners we currently have on Iron Bank, which is currently on the Ethereum side, is the Yearn Vault itself, as well as Alpha Homora V2. And the reason that we believe in this model is because in the smart contract, in the composability, it's kind of similar in this case like a home loan. When a user goes and files a home loan for a mortgage, the bank doesn't say okay, well, here's this glob of money, and I'm just going to give it to you, the borrower. No. It's for your home. So the user doesn't even touch the thing. So the money that's borrowed goes directly to the purpose of, paying for a home. And in that very same case, when we look at a smart contract, we whitelist and we provide a credit limit to these whitelisted contracts, we know exactly where the money can go. So when you look at something like a Yearn Vault, it says, okay, well, we have a DAI, a compound token farming strategy, then great. The only place that money can go is into the DAI farming strategy on compound through Yearn Vault, which are two very credible places. And but as it relates to Alpha Homora, we did have an unfortunate incident where the Alpha Homora contract had an exploitable event very deep and specific within the SUSD contract that caused basically a vulnerability for where the attacker could come into the Iron Bank. I guess more in layman's term, disguised as an Alpha Homora borrower, and then took the liquidity out of the liquidity pool that way. But here's what we learned. Looking back, how could we have defended this better? Well, there's a few things that initially we looked at our DeFi safety score, and it was pretty abysmal because we didn't communicate with DeFi safety folks. We didn't have as good as documentation. We didn't have proven test coverage documentation on the code. Here's where the coverage exists. We didn't have our audit added on there. So we got a really horrible score because a lack of transparency, really. So we've since fixed that. We went from an 8% score, which is severely failing, to 83% score, which is a passing score. Anything above 70 is passing. So since the learnings from the Alpha Homora incidents, we've done the audit with Trail of Bits. We've added this to our report. B, we've updated our score documentation according to the standard best practices that DeFi safety outlined. C, we've launched a bug bounty program for up to $1.5 million on a critical bug. If any hackers out there find something, they can come to us and we'll give you money. It's clean. Just consider that as a white hat event. You get the money. It's clean. It's not a crime. It's not an exploit. You did us a favor. Here you go. Take the money. And then D, we also have partnered with ArmorFi and Nexus Mutual in order for users to go ahead and buy insurance. So as a DeFi user, what can you do? If you're doing something and you're like, look, I'm getting tremendous amount of yield, I am a little bit worried about the risk, then fine. Let's say you're getting 20% yield. Take some of that 20% APY, call it 2.5 right now. The coverage rate on Cream's 2.5% on Nexus Mutual. Great. Take that out of your budget. You got 20% yield. You're afraid the smart contracts might be exploited. Although historically, Cream smart contracts never been exploited and users haven't lost money, you can still buy that for 2.5%. So now you're down from 20% down to 17.5. Okay, that's not bad. Another thing you could do is make sure that the protocols you're investing into, putting your money with, have these bounty programs, because then that means that two things. One, hackers are going to come and poke holes at it so they can earn that money. Two is hackers can come and poke holes at it and they go, wait a minute, instead of actually taking the user's funds, I could just go to the protocol and get paid. Okay, cool, we'll do that. So that makes it less possible for you to lose money. And then, making sure it's looking at something like DeFi safety I mentioned, where you ensure that the protocols have the best practices, have the audits, they have all the right kind of admin control issues locked away. It's documented. You know what's going on. But I will say, just because if a team is anonymous, that doesn't in itself mean it's a bad thing. It's just there are various reasons for why teams can be anonymous or want to be anonymous. So yeah, I guess it's a summary on how we can defend, what the steps we've taken, and kind of hopefully lesson learns there for DeFi users.
Great. Yeah, thanks, Lear. That's very valuable insights, actually, indeed. And insurance is a good keyword there. I think many people are not very well aware, or at least don't consider, but that's an interesting way to cover yourself to some extent. Absolutely. And you mentioned Armor Finance and Nexus Mutual. I think Nexus Mutual had some UI UX issues back then, difficult to use this, but now with Armor Finance sort of becoming a nice interface for Nexus that just covers the underwriting component to it. It is becoming way more friendly from a consumer perspective to go ahead and say, and they have interesting products, as you mentioned, right? Okay, 10% yield, just drop 2.5 of it to us, and we'll send you over the 7.5, but at least you're insured for your principal that is now in this pool that is earning that yield in the first place.
I think it's also interesting to point out that sometimes, an exploit happens and the insurance pays out and then the protocol pays you. So it's kind of like you can double dip. Like that's another thing people don't think of is like Nexus Mutual or the insurance coverage. They're not going to say, well, the thing you bought insurance for paid you, so sorry, you don't get paid. It doesn't work that way. If there's an exploit event, you get paid, whether the protocol pays you back or not. First thing. Second thing is, the bug bounty thing. Like I encourage projects out there to either host their own bug bounty or do something with somebody like Immunify. And then you could also go to immunify.com and then check out all the bug bounties. If you happen to be very good at coding, go look at that, because I think what's really interesting, the statistics I heard is that for a black hat hacker, you take the money, you're trying to run with it. After all the washing and whatever you have to do, and all this risk, possibly getting caught, and most people end up with like 10% of the exploited amount anyway. So you might as well just take the bounty, have clean money, and move on and be a hero instead.
Exactly. Absolutely. Yeah. True. Indeed. Things like bug bounty programs like Immunify is also very, very helpful. As you mentioned, at least allow those guys turn white from black. It's still an expense associated with it, but you risk less, your own reputation as a project, as well as funds associated with the user, if you just accept that expense in the first place. Accordingly, I think in the long run, very valuable approach for project teams to also consider working with team stakeholders like Immunify, as you mentioned. In addition, for users to maybe wrap their head around alternative risk mitigation approaches, such as just looking at some insurance players in the space and check whether there may be some suitable options there for oneself accordingly. All right, cool. Well, then I think we're about to hit the full clock. So I guess we can conclude our very interesting conversation here. It's a very, very hot topic, and I think it'll remain very, very hot for the foreseeable future. Security in DeFi. Thank you for our panelists for making the time and joining us today, Leo, Mindao, and our rep from
Thank
AutoFarm.
you.
And also, thank you very much for the audience bearing with us for the hour and tuning in and listening to all the valuable insights and input from our panelists accordingly. All right, well, thank you for your time, guys.
Thank you. Thank you. Bye-bye.
Thank you very much.
Thanks for having us. Bye-bye.